Good day, fellow investors. Stanley Black Decker. Dennis the Rater said that it is a dividend king, great position, so great business, a lot cheaper than it was. 63% down actually, and thank you for all the suggestions. Just do them: business name, ticker, description, what's the key risks, what are the key rewards, what could be the catalysts, and I might get interested and then make a video, and also will give a lot of value in the comments. Let's start with the analysis. If you like these analyses, smash that like button to support the channel. So the stock has done terribly. It's 50% down over the last 3-4 years. From the peak in 2021, it's down 60%, which is something extremely remarkable. But I remember a lot of people asking me here about it, and then I just looked at the valuation. It was too expensive. And when things change in that risky scenario, anything can happen. It can just continue depending on the market. But the market is a voting machine in the short term and the weighing machine in the long term, and that's something we have to watch. We have to then again reweigh everything and see. The market cap is just 11 billion, P ratio of 12, high dividend yield, so let's make an analysis. We'll do the business, we'll do the financials, we'll do the risk and reward, likely trends, the outlooks, and then we'll see what are the risks and rewards so that you can see whether it fits your portfolio or not. Great presentation on risks in the investor deck from Stanley Black Decker. So let's start with there. A lot of details discussed. They have a good dividend yield, good earnings. They did some acquisitions, so they are constantly increasing their brand base, mostly focused on the US company, dollar, no currency risks, or not that big. It would have been the opposite currently from that perspective. As they are a big business, the plan is to save on costs, on more efficiency, supply chain transformation, other initiatives where they want to save 2 billion per year. Keep in mind, if they save 2 billion on 11 billion market cap, that's a lot. And they have all those supply chain things and everything to solve that. And a huge issue is inventory that has ballooned to 6.6 billion. So these guys have half of their market cap in inventory, and when you have that much inventory, guys, you need to move that inventory. Okay, inflation, this and that, but the finished goods are above current required demand. And they also made some acquisition and everything, but they have to clean that. And if they can clean that working capital, that's another 1.2 billion that can be released. That's again 15% of the market cap if they can unlock that value. On the guidance, the earnings per share for 2022 are pretty wide, of course, without the tax costs of what they sold and everything. It is still at $5 to $6. They had made acquisition, other charges, pre-acquisition related charges. So a little bit of ups and downs there, but $5-6 in earnings per share. Very fluctuated cash flows, expected to be between $500 million and $1 billion. That's a big difference, but still expected to be positive cash flows. If then they can create the savings around inventory and more efficient operations, then it could be very interesting also from an investing perspective. The free cash flow is invested in a way that half of it is for acquisitions and half of it is to return to shareholders. Given the number of brands and spending on merger and acquisitions, when it comes to investing in Stanley Black Decker, I would just focus on 50% of the cash flows, because they invested a lot, yes, but that's also a lot implemented in just keeping the business alive. So that's something very important to think here about. They did a spectacular job on efficiency over the last 20 years from very low margins, though they doubled the margin. So if they can do that further and save more, a few billion here and there, that's a huge impact on the market cap. But they also have significant debt, so that's something to think about. Nevertheless, the free cash flows are there, and we can see here that the potential is there. There are these headwinds now, but if they can work around that, then with a stable company ahead, you have a price to free cash flow of 10, even this is 7, which is ridiculously cheap. And then they have made 10 billion of acquisitions, which is the current market cap. There should be some value there. On liquidity, there is a lot of that, which then backfires with the stock price, as we have already seen it with one stock earlier, eBay also doing buybacks instead of repaying debt. But still, the business is there. They have made an acquisition, so organic growth is low. In case of bad macro, it will be even lower, but still, there are earnings per share, and the market environment, which is likely also what they say from a recession perspective, has gone lower, less spending, negative trends, and that is a normal thing when it comes to investing in such industrials. The full guidance has been slashed significantly, so it was for $10 and now it is for 5.5, and who knows, it might be even lower. So slowing consumer demand as people are not working on their homes that much, and that had a huge impact on earnings. But we as investors have to look for the average and compare that average over time. So if the average is earnings of 5, 6 over the cycle, then you want to get this at 50 or lower. And if we look at Seeking Alpha, quantitatively has a high risk of performing badly, but I want to look at the long-term numbers. So they have been growing slowly and steadily over time. The gross profits also growing steadily, and net income has been a little bit more volatile on the ups and downs, but still lately at $1 billion, and will likely be half of that next 12 months because of the headwinds. Earnings per share, if I look at the historical earnings per share, the average has been, let's say, around 6. So 6 times 10 stock price, still from an average cycle perspective, around 60. If there is a downturn, then even lower. Inventories have ballooned, so that's a big issue. If they can slow it down, something to watch if you follow this. But then again, this adjustment is what crashed the stock price because of too exuberant expectations. That was reflected also in the inventory. Too exuberant the management has been to follow this. And here we have some issues. So the debt is there, 5 billion growing on those acquisitions, but these are near-term risks. So analysts, they are myopic, short-term. They think that the share loss could continue in the years to come. Everyone is very negative. Everyone just projects the trend to continue forever. They can be right in the short term, but at some point it will likely rebound because the cycle will revert. Also downgraded at Wells Fargo because of negative trends in the economy, in everything. I personally think there is nothing wrong with Stanley Black Decker except for the normal standard cycle. Another issue is that the stock really boomed on exuberance, on things going well with the economy, with everything, especially with the pandemic and everyone buying, you always need some things. Now things are returning to normal, the market is getting negative, but then for industrials, it was always too exuberant. If you want cheaper, a margin of safety buy, wait for 50, it's already down 60%, another 20% won't make a difference, and it could get there. So personally, there is competition, they have no moat, but they have good brands. Just a funny note here, kids are not playing around with tools anymore, they are all like this. So also something to think about when it comes to investing. Perhaps it's a Buffett buy. I wouldn't be surprised if Buffett takes it over, cleans it up a little bit, helps with the debt structure, but I think he will make an offer at 50 to pay 60. So that is also a risk, so you can lose money there. When it comes to our portfolio, I don't like really this cyclical industry plays because yes, there is the cycle, but this was overpriced, so it really has to be at cheap bottoms. But when that hits bottom, there are so many other opportunities at bottom, so it's not a stock that I'm going to follow long term. Made an analysis, risk and reward, and just from a sentiment base or personal base, not something that I want to follow, because then I have to follow the industry, how much you want to work on your home, things like that, and simply that's not something that fits me. Nothing wrong with it. I'm looking forward to Buffett buying it. Thanks for watching, and I'll see you in the next video.